We are at the end of this system. And now the cracks are spreading because the next step, I'm sorry. The next step, I can't tell you that this is going to take place at 8:35 on Tuesday morning. And Lacey says, can you explain what the significance of the Japan deal is? Let me take you down this Japanese rabbit hole, although it really isn't a Japan rabbit hole, it really is a debt rabbit hole. And I want you to picture a giant dam that's holding back the river. For years, governments have been just patching those cracks with new paper debt, new promises, new IOUs. Well, at first, the patches seem to hold and they push all the markets up. But as the water rises, the pressure builds, and each new bond issuance, each new debt issuance is another flimsy patch on a wall that was really, frankly, never designed to carry this much weight. We are at the end of this system, and now the cracks are spreading. Investors, those at the top, well, they see the leaks, they panic, they buy gold. They know that the water, once that water starts rushing through those cracks, there's no stopping it. And that's the global sovereign bond market today. That is a dam built on paper promises, straining under the flood of deficits and inflation and the need to create even more deficits and inflation. So let's just jump right in. Because what's actually happening is governments around the world sell bonds, basically, and what those are IOUs, to pay for their spending. But investors are losing confidence. Remember, we talk about that all the time. Confidence in any Ponzi scheme, confidence and new money. Those are the two most important keys. Inflation hasn't gone away. Deficits are growing, and central banks don't look as strong as they once did. So investors are selling those IOUs, those bonds, which makes the bond prices fall and interest rates rise. Remember this beautiful little sterling silver chopstick. When interest rates go up, the market value of the bonds go down. So in the US, Europe, and Japan, borrowing costs are now at the highest that they've been in decades. And when interest rates rise, governments have to pay more to keep the lights on. And as you can see here, there's the Federal Reserve public debt, but there's the international debt securities. And it's all going in one direction, and that's up. And so it makes things look great on the way up, but you have to be able to pay those debts. And that means that there's less money for schools, for roads, or healthcare. Banks and pension funds who hold tons of these bonds, well, they see their balance sheets shrink. And when bond markets shake, it's the biggest market in the world. Well, derivatives, I would say, is probably the biggest market in the world. And those are opaque. We can't really see it. But when a bond market shakes, currencies and stock markets wobble too, because they've used that debt to prop up their currencies and the stock markets. We've talked about the carry trade, which is borrowing at a lower interest rates and then taking that money and putting it into higher yielding instruments. But frankly, it's like dominoes. When one piece falls, the rest start to tumble as well. So the biggest risk is that governments get trapped. They borrow more to keep that dam floating, but the dam just keeps getting weaker and weaker, not stronger. Now, of course, emerging countries feel it the worst because investors pull money out of their bonds first. But now what we're seeing is that that's trickling over into the advanced economies. You know, debt cannot grow to the sky without a level of repercussions. And that means there's a whole bunch of carry trades that will have to unwind. And that means that stocks and bonds and other things will have to be sold whether they want to or not. Because once confidence breaks, we could see crisis spread across the world, just like we've seen in past debt shocks. And it's happening all over. So when you ask me what's happening in Japan, well, my goodness, Japan has actually been the poster child since the 90s of how to fight and lose the deflationary battle. Because remember, there's only one way to fight deflation, and that is with inflation. And so they struggled with deflation for decades. Well, they're not struggling with it anymore. Now they've got the inflation on top of it. But again, all those bonds, 15 years, actually they had way more than that since the early 90s. Any of those bonds that are still in the system are way underwater, and we cannot see it. We cannot see it until it's too late. And that's why it's critically important for you to become your own central banker and hold on to sound money. Critically important that you do that, because this is when the bond market broke. And we've talked about this before. This is the interest rate chart, and you can see where there's been a series of lower and lower highs. That is an indication of a negative trend. But you can also see on this chart where that is going, where we hit zero interest rate policy, tried to raise rates, didn't work very well, lowered them again, but now those interest rates are up much higher. Remember, they tested the negative rates. It doesn't work. This is when that bond market that really started ticking. So Treasuries lead the global bond sell-off amid corporate supply surge. They'll say, oh, this, they'll say that, they'll say whatever they want, but here is the reality of it. The Treasury, the 10-year U.S. Treasury, is the foundation of the global bond market. So if that is what's leading the sell-off, well, we've got some much bigger problems ahead of us. And here are the interest rates on the 2-year, the 10-year, and the 30-year bond. And you can see how those levels are spiking up. And that's what they mean when they say that. Frankly, here's the bigger lesson. This whole dam is built on promises and lies. Bonds, currencies, deficits. They're all claims backed by trust in governments, right? Full faith and credit. So as long as you trust them, you keep loaning money to them, but trust can wobble. Sound money that cannot be inflated away. Gold is the primary currency metal. Silver is the secondary currency metal. That doesn't wobble the same way. It doesn't depend on promises. It's like reinforcing the dam with stone instead of paper. And when the flood comes, stone holds its weight. So what should we all do? Well, we can't stop governments from patching with paper, but we can choose what we hold in our own hands. A solid, sound money strategy with a foundation of gold and silver means that you are outside of the system owning assets that don't vanish when confidence does, because they're used in every single sector of the global economy. This is not rocket science. It just means that preparing families and communities with gold, silver, food, water, energy, community, and shelter, real value, so that when that dam cracks and breaks, we are not swept away. We can hold strong because we are as independent and self-sufficient as we can possibly be. The bond sell-off is a warning, but don't rely only on paper promises. Build your foundation on sound money, and you will have stability no matter how hard the floodwaters, or how high the floodwaters raise, I should say. And they will raise very, very high, because the next step, the next step is visible hyperinflation. And that's what I keep trying to warn you about. I can't tell you that this is going to take place at 8:35 on Tuesday morning, but you can't tell me that it won't. And so the whole point of being prepared is to have everything in place ahead of time. And while I've been working on that diligently since 2008, because that's when I absolutely knew the system died, we don't have that level of time. So local community can create that surety in food, water, energy, security, barterability, wealth preservation, that community peace, and shelter. But globally, we need to have a revolution because we are transitioning into a new fiat money system, into a new monetary system, I should say. And this is the best opportunity that I've ever seen to get sound money, redeemable gold, back in the system again. If we don't do this, we will be in full surveillance. And everything you have will be intangible, and everything you do will be tracked and traced and dictated. Right now, we have a choice. But the bond market cracking, that is, I think the derivatives market is bigger than that, and we can't really see it. And derivatives are all about bets and leverage. The bond market is all about debt. And it looks great on the way up, but it's horrible on the way down.